Okay, we can go ahead and accept that. And what we're going to do today is finish up most of chapter 6. I'm not going to talk about the post-retirement benefit other than pension section. I'm going to ask you to go ahead and look at that on your own. That is a fairly light point area so that we can get into finishing looking at critical parts of chapter 7 and hopefully finishing those tonight. I really want to get us to be able to move to, sorry guys, I'm being distracted by something. I was trying to set my clock correctly and now it's flashing at me. So I'm going to be distracted by that. Okay, I got it now. We're going to, I really want to get us to governmental accounting by next time, because that is relatively heavy on the exam. And I want to make sure that for our remaining classes here, we do have time to cover some of that. So we really need to get into that chapter 8. So let's see what we can do with the key parts of chapter 7 tonight as well. So if there are no questions, I'm going to go ahead and just put up chapter 6. And we had left off, and we're going to head and go to full screen. And we had left off with our second part of accounting for income taxes, doing, of course, deferred tax was the main focus. And where we had left off was here where we were talking about, or we hadn't started talking about, but we were getting ready to talk about uncertain tax positions. So what happens? An entity is taking a tax position, but it doesn't know if that is going to be accepted by the IRS or not. So we're going to see that they're going to have to do an analysis to see what the probability is that they will have a certain outcome, and they will book their deferred tax asset or liability based on the cumulative effect of the most probable outcome. So let's just take a look. An uncertain tax position is defined at some level of uncertainty as to the sustainability of a particular tax position taken by a company. US GAAP requires a more likely than not level of confidence before reflecting a tax benefit in an entity's financial statements. I think I said liability, but it's really more the tax benefit, because with assets, we need to consider that it's more likely than not that there'll be some sort of future economic benefit, of course. So when you come over and you take a look at the next page, and you're going to see that it's pretty easy as to what it is we need to remember. I'm going to ask you to flashcard this. We will recognize the largest amount of tax benefit that has a greater than 50% likelihood of being realized upon ultimate settlement with the taxing authority. So go ahead and flashcard that, but let's just go ahead and take a look at this example down here. And they have this Foxy Inc. And you'll see how to apply that principle here. Is a 1 year year one tax return has taken a tax deduction of $2,000 that results in a $420 tax saving, which there is a 21% tax rate. Foxy believes that there is a greater than 50% chance that if audited, the tax deduction would be sustained as filed, and the tax deduction meets the more likely than not test. However, Foxy concludes that a challenge, it would negotiate a settlement. The following is Foxy's assessment, and you can see that they're telling us that, hey, we could have a 420% saving, but we think that when you accumulate the 26% chance that there'll be a $420 saving with the 25% chance that there will be a $300 savings, you cross over into that more likely than not at the what? At the $300 level of savings. And so they go ahead and they tell us based on that, you can't take the full 420, you would take what? The 300, because at that level of potential savings, you crossed over into the more likely than not, which is defined as more than 50%. So pretty straightforward way that we would deal with that. Okay. All right, good. Now we had the question, I think Serena had asked us, well, what is the tax rate that should be used? And of course, we should use the rate that is in effect at the time that we are recognizing the deferred tax liability, deferred tax asset. But what happens if that extends into future years? If that's the case, then we should use the enacted rate to measure the deferred tax liability, the deferred tax asset. So let's just go ahead and take a look at the example here. I think you're just going to need to remember the enacted rate is the rate that we use. I could ask you to make a flashcard, but I think it's better just to remember, use the enacted rate. But we come over and we say that they began operations in year one and reported $225,000 in income tax before taxes for the year. Stone's tax year one depreciation exceeded its book depreciation by $25,000. And the tax rate for year one is 30%, and the enacted rate for years after year one is 21%. Now, again, we only deal with, remember the term temporary differences to determine what our deferred tax asset, our deferred tax liability is. So we would go ahead, in this case, we had a deferred tax liability because my book depreciation is more than my tax depreciation. It's assumed that in later years that'll turn around. And so we apply the enacted rate. Okay, we looked at this quite a bit last time, how we would calculate that temporary difference. The point takeaway here is that you pick up that enacted rate at 21%, and that generates, in this case, a deferred tax liability. It is what is the deferred part of my income tax expense. And as we've said a number of times now, the easiest thing in any one of these questions, I don't know how much they'll give you questions, but you will see some on the exam where they just simply ask you what is the tax expense for the period, what is the current part of the income tax expense for the period, what is the income tax payable, and that's always whatever's on the tax return times the current tax rate. So if they ask you that, you would do that. And of course, if they ask you the total tax expense, you would simply add those two together. In this case, that would be $65,250. Question. Okay, so you want to use the enacted rate, and I do see that this passkey is useful because it does call out different, terms that the exam might use to try to trick you into using a rate that is the proposed or the anticipated or the, I don't even know, I haven't seen unsigned. I don't even know what that means, but whatever, if they call it that, don't use that. It is what? It is the enacted rate, not the unsigned or proposed or anticipated.
So,
okay. Okay, good. Now, when you take a look, what can happen, okay, is you can have a adjustment from what the beginning balance is in the deferred tax asset or liability, and the amount that changes will be your deferred tax asset, your deferred tax liability, or the erosion of your deferred tax asset for the period generating a higher deferred tax generating a higher tax expense. So when you take a look at this example, okay, they tell us that Julie Company had previously recorded temporary differences of $10,000. So we see the beginning balance and the temporary difference is $10,000. The enacted rate in the year the temporary difference originated was 20%. The deferred tax liability has a beginning balance of $2,000. They simply took what? The 10%, excuse me, the 20% times the 10,000. So we have what? A beginning balance sitting there of 2,000. For the current year, taxable income is 100,000 and the financial statement income is 20,000. So we have what? We have a $20,000 addition now to that temporary difference. So it started out with 20 and now it has, it started with 10 and now it has gone to 30. So we see that when the temporary difference turns around, the newly enacted rate for future periods is 21%. So now because we've had that change in that rate of 21%, we have to go ahead and multiply that 30,000 times the 21%. That gives us what? 6,300, but we already had what? The 2,000 in there, even though that 2,000 came in at what? At a different rate, the 20%. We can use what's already in there, and then we just simply adjust to get to what we need. So we would go ahead and have to add what? We'd have to add not 6,300, but 4,300. And so again, the deferred tax expense is the amount that the deferred tax liability went up, 4,300. The deferred tax liability, of course, to increase it, we have to credit it 4,300. So now it's up to the 6,300 we need. And then again, as I've said now a number of times, the easiest thing in all of this is always to figure out what the current tax payable is. That's simply what's ever reported as your taxable income times the currently enacted rate. And that's the amount that you report as your current portion of your tax expense. And again, if they ask you the total, you would be adding the 21 plus the 43 to give you 25.3 for the total. Question. Okay. So as you got into your homework, guys, with some of these, I think you probably saw that there was a sort of repetition thing that you had to get into here to be comfortable with this material. Okay, so I think the more you work these, the more comfortable you'll be with these. And I think that you will get to a point where you actually start to think that some of these are kind of, I don't know, it can be kind of fun to start to go through some of these because they are at first tougher questions, but then as you get better at these and start doing better with these, I think you'll start to actually enjoy the process of going through some of these.
I have a question.
Okay, good. So with that, I want to turn to the next page here.
Serena had a question. Serena had a question. She tried to speak up twice.
So we come over, and when we look at our balance sheet presentation, we're going to flashcard most of this.
Mr. Lord.
And they tell us that deferred tax assets and liabilities classified and reported as a non-current amount on the balance sheet. All deferred tax liabilities and assets must be netted and presented as one amount, and it just depends. It's either going to be a non-current asset or a non-current liability. If the deferred tax liability is bigger, then it's going to net out to a non-current liability. If the deferred tax asset is bigger, it'll net out to a non-current asset. So you have to net them all out unless they're reporting deferred tax assets and liabilities from different taxing authorities, for example, federal versus state. I don't think the exam will get into that, but you can put that as part of your flashcard. But the main takeaway right there is for you're going to net the deferred tax asset and liability accordingly to get the amounts that you want. Guys, typically don't chat, okay? Can you hear us? I can't hear you. So I see why you had to chat. I did not hear anything. You want to try again?
Yes. Can you hear us?
Yeah, I'm not hearing. Is everyone else hearing Serena? I'm not hearing anything.
Yes.
You can hear her?
Multiple people have been trying to speak.
I'm not hearing. Let's see. Okay, try it again.
Can you hear us?
Yeah, now I can hear.
Okay, thank you. Earlier, I have a question. Oops, it disappeared.
Okay, one second. Can you hear me now? You can't
Yes.
hear me?
Yes,
Okay, 1 second. Okay, go ahead.
yes, we can hear you.
What was the question?
Oh. Oh, yes, you earlier you were talking about intact tax rate. For example, the example number 3,
Enacted tax rate.
yes, inactive tax rate. So it's always a giving in the, I mean, in this example is a giving. We know it's 21%, but in CPA exam, do we need to search for that inactive rate, or we have to calculate, or it's always a giving?
It will be given. This is not the tax portion of the exam where you have to know certain thresholds and rates and those sort of thing. For the, like you would for the regulation. For this, they'll tell you what the enacted rate is, but they may give you a couple of different rates. So they may say when the temporary difference first arose, it was 20%. The enacted rate is now 21%. So you'd have to do an analysis like we did in this. You said example 3. I think you meant example
Yes.
2. That we would have to, make that adjustment, because when the difference first set up, 10,000 went in there, but by the time we get to the new year, an additional amount came into the temporary difference. We use the enacted rate, and so we just have to adjust the deferred tax liability in this case accordingly to bring it up to the amount that it should be.
Okay, thank you.
Some reason, if I take the computer out of tablet mode, it throws a fit and does what it did. I had to reboot, but so it seems like we're back on track now. So, okay, good. Okay, now operating losses, and I find this a little annoying that Becker seems to be talking about a provision that was put into the tax law because of COVID that has now expired when they first start talking to us here about this. And I feel like the only reason they are even talking about something that is no longer applicable is so that the example that's on the next page is still interesting. Meanwhile, it would be kind of like the examiners asking us what we should be doing in 2018, 2019, 2020, 2021. Meanwhile, we're taking the exam in 2022. So I'm not going to focus on carry backs because those are no longer allowed. I'm going to focus on carry forwards because that's the potential impact for the 2022 preparation of financial statements. And we are taking an exam in 2022 called Financial Accounting and Reporting, which would not be dealing with carry backs. Okay, so, but I want to read what they say about carry backs so that you at least have a notion of how it used to work, but these are no longer applicable. So net operating losses arising in 2018, 2019, or 2020 tax years can be carried back 5 years and carried forward indefinitely to offset taxable income in other years. So I'm reading that not for the carry back part because we're past 2020, but maybe they did carry those forward. If they carried them forward, yeah, then they would be applicable to future years. Now, you can see that net operating losses carried forward to taxable years beginning in 2021 or later are limited to 80% of taxable income before the NOL, net operating loss deduction. So go ahead and flashcard that because that's a very precise rule that you need to know for carry forwards. And then net operating losses arising in 2021 and beyond cannot be carried back, but can be carried forward indefinitely, limited to that 80%. Okay, that's the main takeaway there. They can be carried forward They cannot be carried back if they arise in 2021 or later. Those losses arising in 2018, 2019, 2020 can be carried forward, and they are not subject to any kind of limitation. So that's the main takeaway there, is the carry forwards, how to handle those. Okay, so let's just go ahead and take a look at what happens. And it makes no sense to me why they would be talking about a carry back. I'm not going to look at carry backs. I'm only going to look at carry forwards. Okay. So if an operating loss is carried forward, the tax effects are recognized to the extent that the tax benefit is more likely than not to be realized. In other words, I think I'm going to have taxable income in future years to be able to apply the carry forward. Tax carry forward should be recognized as deferred asset because they represent future savings in future tax periods, because when I finally have income, I can apply those loss carry forward. So I had a loss in 2021, I can carry it forward to 22, 23, and so on. Now, of course, limited to that 80% stipulation. Now, I also want you to flashcard here, net operating loss carry forward should be valued using the enacted future tax rate. And again, they would give that to us. So go ahead and remind yourself of that you use the enacted rate, although I don't think I had you flashcard that before. You're just going to remember using the enacted rate, but go ahead and flashcard that. And then they give me an example here. So tax credit carry forward should be valued at the amount of the tax payable to be offset in the future. So if we had a current net operating loss of 100,000 and the enacted tax rate was 21%, we would go ahead and debit a deferred tax asset of 21,000, credit tax benefit. Now, flashcard that what the deferred tax asset, which is on the balance sheet, will reduce tax payable in a future period, and the tax benefit would reduce the operating loss of the current period, because you have what you have instead of a tax expense, you have a tax asset, a tax benefit, I should say. You obviously wouldn't have a tax expense because there's no income. But you have this, you literally going to reduce the loss that you're reporting, the net operating loss that you're reporting, by the fact that you have this tax benefit. Let me just go ahead and put it down. That's on the income statement. The asset obviously is what? On the balance sheet. Okay. That's the main takeaway there, guys. They go through this long example. I don't want to go through this because it's bringing up carrybacks, which are no longer allowed. So I don't care for that. Okay, I don't care for confusing our minds with things that don't apply anymore. Okay, good. Let's just come over and let's take a look at how we should deal with dividends. Okay, and we can see that taxable income is the dividend received. So if we're holding an investment under the equity method, what would happen is we learned back in chapter 4 now, okay, we would have done what? We would have taken our share of the investee's equity if we were using the equity method, if we hold more than 20% of the shares, whereas under tax law, you can wait until the dividend is actually received to take the income. Further, we have what? We have this issue where they let us exclude some of the dividend that we receive that is not taxable at all. So when you have this situation, you're going to have what? You're going to have a permanent difference for the part that's excluded. And then you're going to have a temporary difference just on that part that is not excluded. And then that's going to what? That's going to generate a timing difference depending on whether or not the dividend has actually been paid out or not, or difference between the amount of dividend that's been received and the amount of income that we would have taken using the equity method. Okay, so where this really applies here, guys, is if you are holding what? If you are crossing that 20% threshold, okay, when you start to use the equity method, that's when we're going to have to start to know what the temporary differences are going to be. And this is a case where we are going to need to understand, and this kind of gets more into the regulation part of the exam, what the exclusion percentages are associated with different holdings. And when it really comes in, there'll really be differences here for the amounts, temporary differences for the amount that are in excess of the exclusion. The exclusion amount is going to generate a permanent difference. Okay, so let's just go ahead and take a look, and we can see that in this example down here, I just want to jump down to the example, and they give us the facts here, and we have a 25% owned investees. So we know that we're using the equity method, right? Investees net income is 2.4 million, of which 600,000 would be attributed to the investor because we own 25% of the stock, right? The 2.4 times the 25%. The investee's dividend is what is going to be 500,000. The investee paid dividend of 2 million. We get 25% of that. So if we get 500,000, that would be reported on the tax return. Now, because, and of course, we would have to use that flashcard that we had up there, we are in the 65% exclusion range. Okay, so since we're in the 65% exclusion range, that part is permanent, excuse me, and we'll apply this 21% to which is the enacted rate here, to the temporary differences. Okay. Now, just to make sure that we're comfortable with where they came up with these temporary differences, I don't know, the way I would have probably looked at this would have been to take the 500,000 times what? Times 1 minus the 65, which is what? 0.35. And that gives me what? That gives me the amount that would be reported as taxable income, because I get to exclude 65%. And that's a permanent difference versus what? Versus the 600,000 times the 0.35. That would give me what? That would give me this 390, thus doing what? Thus generating a temporary difference. The 65% will never enter into taxable income. It's a permanent difference. So I just have to focus on that part that would not be excluded. And that gives me a difference between the 210 and the 175 of 35,000. That generates what? That generates the deferred tax liability, because it's assumed that eventually what? There'll be a dividend that will be paid out on that remaining 100,000. And that amount will be taxable in future years, right? Thus generating a deferred tax liability. And so again, guys, the easy part is always what's the current portion of the expense, what's the income tax payable, that's always a piece of cake. And then we have what? We have an addition to our tax expense for the deferred when we have what? An increase in our deferred tax liability here, because we're assuming that 100,000 will be paid out in a dividend later, and then 35% of that difference will be attributable to, will be taxable in future years at a rate of 21%. Question. I guess you could have taken 100,000 times 0.35 and came up with the same answer. Okay. Okay, now on the next page, we do get into disclosures, guys. I'm not going to read off the disclosure requirements to you here. I do, however, want you to flashcard what the disclosure requirements are. I typically don't read those off because they are what they are, and they're self-explanatory. You simply have to disclose what they're telling you have to disclose here. So just go ahead and flashcard those. Okay, good. So with that, let's go ahead. They do give us a couple little summaries here, which I think are probably almost incomprehensible. So we're not going to worry about those, but let's go ahead and let's take a look at our first poll of the night for a couple more deferred tax questions before we get into chapter 7. Okay, guys, let's go ahead and take a look at this one. Give you a little more time because that one is a little bit, depending on how you looked at it, might take you a little longer. Good. Looks like a good chunk of us got this right. A few of us missed it. The correct answer is D. A couple of us picked B, which I can kind of understand why you might have wanted to pick B, but the correct answer is D. Okay. Now, let's take a look at this one. And again, this is a little annoying because I don't know why Becker's contemplating that we should understand a question in which you're asking us what would be reported in the 2021 income statement. We are taking an exam in 2022, okay? But maybe they might say something like this on the exam. I doubt it, okay? But what happens? You take a look and we have this $700,000, okay, loss, and we have elected to carry this forward. We could have carried it back, but now we're carrying this thing forward. And so we look at this, and since we are carrying it forward, now it would be relevant to 2021, 2022 reporting. And so what would have happened if we had this 700,000, I guess I'm gonna write it again, and we multiply that by 0.21, that means that we would have had 147,000 deferred tax asset at that point in time. So we would have gone ahead and done what? We would have debited the deferred tax asset in 2021. And so we would have ended deferred tax asset. We would have ended 2020 with 147,000 deferred tax asset, right? Then what happens? Then we have income in 2021. We have this 1.2 million. Now, we want to be able to use that deferred tax asset carry forward that we had, but we got to be careful that we don't take too much, because we are limited to what? We're limited to only 80% of that. So when you go ahead and you multiply 1,200,000 times 0.8, you do get this 960,000. So we're good. We can do what? We can use the entire carry forward here. So we have 1,200,000 is our book income. We subtract the what? 700,000 of carry forward we have. So now we have what? 500,000 that we will be reporting as taxable to the IRS. That's what? That's times 0.21 is giving me the 105,000. That would be my current portion of my tax expense. And then I would have what? I would have the use of this 147,000 deferred tax liability that I'm using up now at this point in time, right? At that time, then, since that's the two together, the deferred tax asset that I'm using up, plus my current tax, you add the two together, you get what? You get this 147,000 that you're using up, plus the 105 for the current. That's why the total is 252. Now, that's sort of the theoretically thoughtful way of answering it. The other way to look at it is they really are asking me what? The total income tax expense, which is what? As we've seen, it's always the total of whatever the change in the deferred tax asset liability is, plus the current portion. And so that's the total. You could have taken the 1.2 times what? Times the 0.21. And I think maybe a couple of you saw that. That would give you the same answer, the 252. Okay. The problem I have with doing it like that is that works for this problem, whereas this works what? This works to, because often the questions will parse it out as to the current versus the deferred portion. This is a more consistent way of treating these questions as you go through. Okay. Question? Okay, guys, let's go ahead and look at question number 2 then. Okay, guys, we're about 2 minutes into this. I'll give you a couple more minutes. These deferred tax questions sometimes take a little more time, so I'll give you a couple more seconds with it. Remember, on the exam, you should never spend more than 3 minutes with any one question. Sometimes with these deferred tax questions, I find I got to look at them a couple times to make sure I've got the correct direction going. Is taxable income more or is book income more? And that's relevant to this particular one. Okay, so looks like most of us have had a chance to look at this one now. So I'm going to go ahead and end the poll if I can get my mouse over there. Get my cursor over there. There it is. Okay, good. All right. So most of us got this right, 78% of us. Now, a couple things. When you look at this question and you start to look at the choice, and the answer here is D. Most of us got it right. You start to look at this question here, you immediately need to see, well, look, they're asking me either asset or liability. So I need to figure out which is more. Is it the book income that's more, or is it the tax income that's more? Because if the tax income is more, I have a deferred tax asset. If the book income is more, I'll have a deferred tax liability. So I can eliminate two of these choices right out of the gate, right? It can't be both. Okay, so I come over and I say, as a result of the difference between the depreciation for financial reporting purposes and tax purposes, the financial reporting basis of this asset acquired in year one exceed its tax basis by 250. So that's telling you what, hey, I've got 250,000 more of depreciation for book purposes. That means what? That means I'm going to have a deferred tax liability because I'm going to be reporting a deduction now for, an expense now for book purposes that I won't be able to take for tax purposes until later. So you go ahead and you immediately get rid of A and B. Then you sit there and you say, well, I've got this temporary difference of 250,000, and I need to figure out what rate I should apply to it to come up with a deferred tax, which we know now is a liability. And they tell me the enacted rate is 30% for year one and 21% for future years, which is when that difference will turn around, right? So I need to go ahead, and I'm assuming that the 30% was what was choice C probably. Okay, so that's not correct. And so you have to go ahead and pick up what the 21%, that gives you the correct answer here at the 52.5. Okay. Okay, good, guys. That gets us through that module. I'm not going to get into the discussion here of the pension. Is that here? Oh, I thought it was here. Oh, I guess it's in another chapter. It's in chapter 7. I'm not going to get to. I'm not going to do it in chapter 7 either. So we're done now with chapter 6, notwithstanding that I have asked you to look at the leases discussion, which is at the start of chapter 6. So don't forget to do that. Okay. Question? All right. I think it makes sense to go ahead and take a quick break here to allow you to find chapter 7 now. If you don't have that in front of you, you should go ahead and pick that up now. So you can start to look at the material for chapter 7, which will start. And I'm going to show you some point values associated with that when we come back. And then I'm going to show you how we're going to attack this stuff today. I think what I want to do is start with module 3, go through to module 5, and then I'm hoping we have time to come back and pick up some of the discussion in module 1 pertaining to treasury stock. But I'll talk about that when we come back. Let's go ahead and take about 10 minutes, guys. We'll come back at 6:10, okay? Okay, guys, I'm going to go ahead and resume the recording and jump us into now the table of contents that you can see on the screen here for chapter 7. Now, stockholders' equity, okay, and there's going to be some basic discussion of stockholders' equity that, you know, it's going to cover maybe about 5 points on the exam. But the area where I'm going to focus us, time permitted here today, is going to be in the area of treasury stock. Okay, and we're going to have to understand 2 methods, which I find annoying because you have to understand both the cost method and the par value method. Meanwhile, everybody uses the cost method. I don't know why FASB just doesn't do away with the par value method, and I don't know why the examiners spend time with the par value method, but we'll have to understand both of those, and that's about 5 points as well. Okay. There will also be some discussion as to how to account for dividends. We're not going to go through that here together because I think that is pretty self-explanatory for you, but that's about 5 points on the exam. So time permitted, I'm going to come back and cover the treasury stock discussion and this discussion a little bit with you after we have gone and talked about stock compensation, which is about 5 points. Earnings per share, I'm going to go through with you because that gets a little bit convoluted, or not convoluted, that's probably not a good word, but multi-layered, let's put it that way. In terms of how you calculate the primary earnings per share is pretty easy, but it's the diluted earnings per share that you're going to want to, that I think is worth us spending time together here tonight. Statement of cash flows, most of you had expressed that you do want a review of that. That is about 10 points on the exam. And statement of cash flows is important because we're talking about it here, because we're talking about commercial entities. But we're going to see that we're going to use this understanding when we start talking about statement of cash flows that are prepared by government entities. And then when we finish up with not-for-profit entities, we see that they prepare a statement of cash flow as well. So it is a fairly pervasive part of the FAR exam as it deals with the different types of entities that we deal with: commercial, not-for-profit, and government entities. So we'll spend some time with that. I think you'll see that statement of cash flows, once we get a couple of key flashcards down on that, is actually going to be a relatively easy 10 points for you on the exam, but you definitely should expect task-based simulation, multiple choice questions in different areas and different types of entities on your exam. Okay. All right. And then I'm going to let you look at the discussion here of financial statement of employee benefit plans. Pensions are no longer tested. This is not dealing with pensions. Pensions are no longer tested on the exam. It's dealing more with healthcare benefits there, and that's traditionally been a fairly light area. They got rid of pensions maybe last year or the year before that, because nobody has a defined benefit plan anymore. All companies offer defined contribution plans now, and so they have de-emphasized. They've removed it from the exam, the ultimate de-emphasis. Okay. All right, good. And so if there are no questions on that, I'm going to go ahead and I'm going to start with Module 3, stock-based compensation, although I'm pretty sure we should have time to come back and cover those couple of these other things dealing with stockholders' equity, but I want to be sure that we cover the modules dealing with the stock compensation and whatnot and the earnings per share. So I want to start with that, and then we'll probably have time to come back to those others. So let's start with Module 3, okay? And let's start with the discussion of employee stock options. Now, this was an area of controversy probably before you were born, or even, definitely before you decided you wanted to be an accountant. It used to be the companies didn't have to record an expense for their employee stock options if they set the option price below above the market price at the time that they granted the option. Well, FASB looked at that and said, well, what price you choose shouldn't dictate whether or not you recognize the compensation expense. So FASB came out and said, no, options have value. And if they have value, then there's going to be an expense associated with the granting of a employee stock option plan. And so that accounting is what we're going to have to review here today. Now, when we look at recording stock compensation expense, it has to be a compensatory, and I can't say that word properly, non-compensatory plans do not contain compensatory features, do not generate a compensation expense. Okay, so you'll see, and I'm just pointing that out because you'll see a lot of times at the very beginning of the question, they'll say, well, it is a compensatory, I wish I could say that, plan. You may be wondering, well, why are they saying that? Well, because if it's non-compensatory, there is no compensation expense. Okay. Now, to take a look at how we will deal with some of the key definitions, guys, and this is not something that I feel you need to memorize. I just feel you need a quick review here of what some of the key terms are. We're going to look at the example here, and you're going to see that this is pretty straightforward in terms of knowing how to apply the different terms to answer a question. Okay, so you have the option price. That's the price at which the company says the employees can exercise the option. You have the exercise date, and that's the date as to when the employees can exercise the option. So they'll say the option price is $25 per share, and you can exercise it beginning January 1st of year 3, whatever. Okay. The fair value of the option. Fair value of the option is not the option price. Fair value is what? Is the value of that option. And often companies use this Black-Scholes model, although the CPA exam, I think, is reluctant to call it out as the Black-Scholes. They'll say an appropriate model because I think maybe Black-Scholes wants a, what do they call that? Where'd everybody go? How did we lose like half the class here during the break? Okay, I guess that warrants me taking a look at who bugged out of class after the break, because that's a no-no. You don't do that. Was there something going on that I didn't know about? I mean, I'm almost better off just circling who's here than circling who left. That's a no. You don't do that. Okay, looks like I'm sending out some emails here after class. Okay, all right. Then you continue on and you have the grant date. That's the date that they have issued the option. The vesting period is important because it's how long the person has to wait until they can actually exercise. So from the grant date to the exercise date, that would be the vesting period. And then the service period is the period over which we will recognize the compensation expense. Okay. Now, we call it the fair value method, and we say that under the fair value method, we will have to consider what the price is of the option. And note, they tell us that any CPA exam question will supply this number. So it's not like they're going to make you go in and somehow, do the, valuation of the option. The exam will give you that information. Okay, so let's just take a look, and I think you'll see that once you see some of the numbers, it's pretty straightforward. Notice I haven't asked you for any questions here. For any flashcards, I should say. But on January 1st, year one, ABC company granted options exercisable after December 31st, year two, to purchase 10,000 shares of $5 par common stock for $25 per share. On the grant date, the market price of the stock was $20 per share. Don't fall into that trap, guys. That number is almost irrelevant in most questions, okay? And using an acceptable valuation model, the option had a total fair value of $50,000, and the options are to serve as compensation for service. That's a service period for year one and year two. That is important. Okay, that 50,000 is important. That 20,000 really is irrelevant. It's just a distractor in this question. Okay, so you come over in this scenario, and we take the what? We take the 50,000, which is the value of the option, and the idea is that the individuals are going to work really, really hard over those 2 years to earn those options, right? So what we'll do is we'll take compensation expense of 25,000 in year one, 25,000 in year two, and we have to credit something. And so we credit a stockholders' equity account called additional paid-in capital stock options. That's it. That's what you do those 2 years. Now, what I find interesting when you look at the financial reports of tech companies like Apple and that kind of stuff, that's a pretty big expense that they're paying, that they're having to show out on their income statement. But it's also what? It's also a major add back to net income when you calculate cash provided by operations, because there's no cash going out as a result of this. So even though, companies kind of whined about having to show the expense, they really weren't hit that much because it gets to be added back to net income. In fact, if I'm an analyst, I'm looking at that and I'm thinking, well, hey, the time is coming when potentially more cash is going to be coming in to the company, because they're going to go ahead and start to see some cash come in when the employees actually exercise the option. Okay, so let's just go ahead though, and let's see what happens when the option is actually exercised. And so when they exercise the option, we have what? We have this, and remember the option price was $25 per share. It was what? 10,000 options. So if those options get exercised, they would go ahead and debit cash for 250,000. They take what? They take the amount out of additional paid-in capital stock options now. They credit the common stock at par. And then, and I guess you could say, well, the difference is going to be a credit to additional paid-in capital. But the way I look at that number is I say, well, look, $25 is the option price minus what? $5 par gives me what? Gives me $20 per share. That's additional paid-in capital in excess of par times the 10,000 shares. That gives me 200,000. And then we are simply doing what? Assigning that 50,000 out of what? Out of additional paid-in capital stock option and into additional paid-in capital regular APIC. That's where the 250,000 comes from. Okay. Okay, good, because you might get a question where they might say to you, well, what's the change in the, in the APIC account? Well, I don't want you to have to make the whole journal entry to come up with that. That's how that would have been done. Now, if the options expire and, some or all the options expire, then we would go ahead and debit additional paid-in capital stock options for those that expire and credit additional paid-in capital expired stock options, because the employees don't have to exercise them. I think that it would be likely that they would. Of course, they wouldn't exercise them if the price of the stock had dropped below $25. They're absolutely not going to do that. But assuming that this price of the stock is, above that 25 at that point in time, then they would go ahead and exercise that option. Notice the market price of the stock at the time of the option was granted was irrelevant. Okay. Now they give us the numeric example here for the expiration of the options. So let's say that instead of exercising all 10,000, they only exercise 5,000. Again, we would debit the cash for the amount of cash that comes in, issue the common stock at par. Half the options are taking the amount out of additional paid-in capital. And again, there's the APIC. And then for the portion that expires, which would be the other half of the options, which had a value of 25,000, we just reclass that out of stock options and put it into expired stock options. Question? Okay, pretty straightforward approach here. FASB wanted to do that a long time ago, back in the 90s, and they got lobbied off the page for a while there, but they finally were able to get their way to do the accounting that way, which is, conceptually a better way of doing this than the old way.
May I ask a question? So when employee cash out their stock option, does that mean the company cash will go down, right? Their asset?
What do you mean they cash out?
Exercise their option.
Well, they exercise the option here. If they want to sell the stock now, I guess they can, because they own the stock.
But is that going to impact
the company?
Will that impact the company's cash?
How?
Because
They turn around and they sell this stock to other traders. How would that impact the company? So I bought the stock. I own the stock now, right? If I sell the stock to you, how does that impact the company?
But okay, maybe I misunderstood the whole
If
concept.
I sell the stock to you, how does that impact the company?
So for certain company, they grant stock option to employee as part of the compensation. So the employee doesn't have to pay anything.
Well, that's not a stock option. Then.
Okay, so I misunderstood the concept. Thank you.
Yeah. The employee exercises the option here. They buy the stock. They buy the stock, then they sell the stock, probably is the next thing they do, and that's when they get their money. But that doesn't affect the company. That's between the employee and whoever they sold that option to. Now, in this case now, with stock appreciation rights, which sounds more like what you were contemplating here, entities entitles the employee to receive an amount equal to the excess of the market price at the exercise date over a predetermined amount, usually price at the grant date. The excess that is multiplied by the number of rights outstanding is reported as compensation expense and a liability. Compensation expense for stock appreciation rights outstanding must be adjusted annually. Unlike stock options, which I think maybe what was you were contemplating here, stock appreciation rights do not require the employee to make a cash payment to acquire the stock. Okay, so you're not going to buy the stock. So let's just take a look And they tell us that at January 1st, Loud Corp granted Mort, its president, 10,000 stock appreciation rights expiring on January 3rd, year 4. Upon exercise, Mort may receive cash for the excess of the market price of the stock on that date over the market price on the grant date, and the service period runs for 2 years. So on January 1st, it's $30. On December 31st, it's 45, and on December 31st, year 2, it's 40. And Mort exercises all the options in year 3 when Loud stock is still sitting there at 40. And so we're going to go ahead and prepare the appropriate journal entry, year 1, year 2, and then year 3. So we come over and when he actually exercises the option. So, I mean, not the option, but the appreciation, right? So market price at December 31st, year 5, year 1, I should say, was 45. Market price was 30. That's what? Appreciation of 15,000. Number of stocks is 10,000. Total compensation expense is 150. And since it's what? Since it's a 2-year period, we take half of that into compensation expense and we credit the liability for that because we're expecting that at some point this person will say, okay, yeah, I want to exercise this appreciation right. I want some money, right? And when you're going to have to pay money out, that's a liability. Okay. Then we come over and we get to year 2, and now the market price has come down a bit from 45 to 40. The market price at the time that they exercised the option was not the option, but they granted the appreciation rate was 30. So we have an appreciation of 10 times 10,000. So really the compensation should be 100,000. We've already taken the what? 75. This is a change in accounting estimate, guys. So to bring it up to the total now of 100,000 by the end of that 2-year period, we simply take an additional amount of 25,000. And now because Loud went ahead and Loud, waited until, the year 2 to exercise that, we would go ahead and debit the liability and credit cash for 100,000, which is the difference between the price at the time the grant was the appreciation right was granted and the price at the date that was exercised, which was still at 40 in year 3. Okay. Okay, good. Still at 40 in year 3, right? So that's where the 100,000 comes in. 40 versus the 30, which is their right, times the 10,000 gave total compensation of 100,000. So that's a case where, there was no cash coming in. They simply, cashed in on the right, the stock appreciation right. Okay. I say there was no cash, there's no cash coming in. Okay, good. Let's go ahead and let's take a look at this question. This is an interesting question. Okay, looks like most of us had a chance to look at this one. I wanted to go to 3 minutes because it might take you a second to read through all that. But let's just go ahead and take a look at this. And almost everybody got it correct. There was one person that wanted C. I'm not sure where C is coming from. I could see maybe B, but the correct answer is A here. But let's go ahead and let's take a look at this one. And so the answer is A, but let's take a look. Most of us got it right, but let's take a look at this one. So we have a situation where January 2nd, the current year, Kind Company granted Morgan as president compensatory stock options to buy 1,000 shares of Kind's $10 par value common stock. The options call for a price of $20 per share that are exercisable 3 years following the grant date. Morgan exercised the option on December 31st of the current year. The market price of the stock was $45 on January 2nd. Who cares? Okay, that used to matter. That doesn't matter anymore. And $70 on December 31st. Using an acceptable option pricing model, Morgan determined that the fair value of the option was $30,000. By what amount should stockholders' equity increase as a result of the grant and the exercise of the option? Now, what makes this question a little tough is you have to go back and see that what Morgan exercised the option in December 31st of the current year. So even though we have a 3-year vesting period, they exercise the option in the first year, right? Okay, I mean, not 3-year vesting period, but 3-year service period, but they went ahead and exercised that option immediately, right? Okay, in the first year. So what happens? We take this 30,000 and we have to divide it by what? The 3-year service period, okay? And that gives us what? 10,000 per year, of course. So in the current year, in year 1, which is what they're asking us for in this question, we would have done what? We would have debited compensation expense for 10,000 and credited what? APIC stock options for 10,000. Okay. Now, what happens then in that same year? This Kind or whoever it is, or Morgan, I guess is the employee here, goes ahead and exercises the option. Okay. So when they exercise the option, they're going to have to exercise it. The price was what? $20 per share. Okay. And so $20 times how many shares is it? Times 1,000 shares. Okay. Means that there'll be what? There'll be $20,000 of cash that's going to come in on this. Okay. So we know we're going to have to debit cash for 20,000. Since the person is exercising the options, we know we'll have to do what? Debit APIC stock options for that 10,000 because they're exercising the options at that point. They'll credit the what? Common stock, and we credit the common stock at par. The par was, what was the par on this stock? $10. Okay, so 10 times 1,000 is going to be what? 10,000, and then we will credit regular APIC. We credit regular APIC for the difference between the option price of 20 and the par value of 10. That's 10 times 1,000. So that gives us what? 10,000 that has to go. And this 10,000, we reclass it out of the APIC stock options and into regular APIC. So APIC gets credited for what? Gets credited for this 20,000. Now, when you look at this question, that's why I was saying I could see why some folks might think that the answer should be what? The answer should be perhaps someone might think that the answer should be B here, because if you look, my stockholders' equity accounts got credited for 30,000, right? But what happens? The question asked me stockholders' equity increase as a result. Well, it's this 30,000, but what happened to retained earnings? Retained earnings came down 10,000 because I did recognize what? I did recognize a compensation expense, didn't I? So since my retained earnings came down 10 and my stockholders' equity went up 30, that's why what? That's why 20,000 is the answer. So that was a little bit tricky on you to sit there, and nobody picked B, so I guess you all caught that. Yeah, I guess you all caught that, so it didn't, you were okay with it. It would have confused me. I wouldn't have thought through that 10,000 of the retained earnings going down. I probably would have messed up and picked B. I'm not sure why anyone picked C.
Did anyone do this differently?
Uh-huh.
Oh.
You looked at it differently?
I did. I got the same answer, but I took in the beginning, instead of 10,000 a year, I did all 30 up front. So my first, for that January 2nd, so I debited cash for 20, debited APIC for 30, credited common stock for 10, and then my plug was the other APIC credit for 40, but I still got 20.
Okay. Yeah, I
Was that
think,
just luck?
well, I see what your logic is, that you're saying that the, since they exercised it
All in that
all
1 year.
in that 1 year, that the entire expense would have been taken, but that we're supposed to amortize, or, allocate, I guess a better word, over the 3 years. Because he still theoretically is, we have a 3-year period, so you can't take it all in that first year.
Okay.
We
Thank
don't
you.
we don't let the decision determine the compensation expense, in other words.
So I guess I just got lucky then.
Well,
It's the same answer.
lucky by thinking good. Well, I mean, it sounded like you just, thought some weird thing and then got the right answer. So, okay. Okay.
Can you scroll
good.
back down just for a second? Sorry, I want to write one more.
Scroll
down.
down.
Yep, just so I can see the rest of your notes. Thank you.
Okay. Yeah. Okay, good. Let's go ahead and turn our discussion now to the earnings per share calculation. Okay, can we move on? You're okay now, Alan?
Yes, thank you.
Okay, so let's go ahead and let's take a look at the earnings per share. I don't know why this has gotten me into the mode of there. No, that's a little better. Earnings per share. Now, basically, we have basic earnings per share. Basically, we have basic, sounds funny. And then we're going to have, diluted earnings per share. Okay, now basic earnings per share is income available to common shareholders. And then we divide that by the weighted average number of shares outstanding. Now you should flashcard that, but I want you to be aware that in chapter 7, somewhere we have a bunch of ratios. Do we give you, is it chapter 7? Where are the ratios now? good question. Looks like they moved them. Hang on 1 second, guys. Oh, okay, ratio analysis is now in chapter 2. Okay, so you should have a flashcard that lists out every single ratio that you need to know. And did I mention that you need to know all of those ratios? Did I mention that back in chapter 2? So you have to know all of those ratios that are talked about in chapter 2. And I don't think I went through those with you. I just told you you had to watch the video on that and you had to know every single one of those ratios. And the basic earnings per share formula was there. So you should have a flashcard with this ratio already, okay? But make sure that as part of that flashcard, you know how to calculate the elements associated with the calculation of basic earnings per share, okay? Starting with what? Starting with income available to common shareholders, okay? Let's take a look at that and let's flashcard how we'll come up with that numerator, okay? And they tell us that income available to common shareholders determined by deducting from the line item income from continuing operations and net income dividends declared in the period on non-cumulative preferred stock, regardless of whether they have been paid, and dividends accumulated in the period on cumulative preferred stock, regardless of whether they have been declared. Okay, so you have to look to see what classes of stock they have and know how to treat those. And you're calculating it for net income and income for continuing operations, dividend declared in the period on non-cumulative, regardless of whether it's been paid, and dividends accumulated in the period for cumulative, regardless of whether they have been declared. Okay. Now you come over and they tell us that if there's a loss from continuing operations, the amount of loss should be increased by the preferred shareholders' dividends or claims to determine income available to the common shareholders. So the loss becomes less. You subtract those amounts from the loss, and the loss, I shouldn't say becomes less, the loss becomes bigger, becomes greater. Okay, now weighted average number of shares outstanding. Okay, and so let's take a look at that, and you should flashcard this: shares outstanding at the beginning of the period plus shares sold on a time weighted basis minus shares acquired during the period on a time weighted basis. In other words, treasury stock, plus stock dividends, which are retroactively adjusted, minus, and you don't see this much, reverse stock splits, which are also retroactively adjusted. That gives you the weighted average number of shares. Now, for our stock dividends and our stock splits there, okay, because notice we had stock dividends and stock splits and reverse stock splits as well. But let's just look at stock dividends and stock splits here. Stock dividends and stock splits must be treated as though they occurred at the beginning of the period. Okay, so make sure you include that on the flashcard. Now, let's look at the example over here, and you'll see how you're gonna, retroactively adjust for these stock splits. And when I look at this, they give us a couple of different ways of solving this problem. This is how I would do it. We have shares outstanding at January 1st of, 1 million. It's the million shares, not dollars. Then they have a 2-for-1 stock split. Well, we saw from the flashcard that has to be what? Retroactively adjusted. So the way I do it, guys, I don't agree with either of their approaches. I sit there and I say, well, okay, that means that they started the year with what? 2 million shares. I just do that. And then they issue additional shares at what? At 4/1. That means those 2 million shares, because we adjust retroactively for the stock split, right? So I just assume, even though it didn't happen until they tell us until March, I assume that that happened what? January 1st, and they had 2 million shares. And that sat there like that for what? All of January, all of February, all of March, until they issued what? An additional 300,000 shares. So the number of shares went from what? Went from 2 million to 5 million, didn't it? Okay, so that's 5 million. And those 5 million sat there for what? For all of April, all of May, all of June, all of July, August, September, October, November. I count on my fingers for that. That's what? That's 8 months. That's 8 months. Okay, so for 8 months, the 5 million sat there. Okay, that gives me the weighted amount for, and by the way, you wouldn't multiply that by 2 again, by the way, guys. It's just 2 million times 312, so it give you the 500,000, the way I'm doing it. And then they bought back 500,000 shares. So that puts me at 4,500,000, and that sat there for just the 1 month. So that's times 112. Okay. So when I go ahead and I do the math, I get the weighted average number of shares. That's the way I like to do it. You may look and you may like the alternative solution. You may like the way they set up the solution to begin with. From my mind, I just like, okay, I'm going to take stock splits back to the beginning and just assume that that's the way it was at the beginning of the period. Okay. Question. All right, good. So let's go ahead and let's take a look at this question here. Okay, it's about 2 minutes here, and just about everybody has made a choice, so that's good, and just about everybody got it right. So good. So I think you saw here the trick was to what? Retroactively apply that stock dividend to the beginning of the year. So there really was none of that waiting, right? We had what? We had the 100,000. And they issue a 6% stock dividend. That means we take what? The 100,000 times 0.06. that means they issued an additional 6,000 shares, and there is no weighting on that. We assumed that that was outstanding what? To the beginning of the period. So you simply add that in, and there's no, having to multiply it by some fraction of the year, like 1/12 or whatever it would be there. We take what? We take it as though it had been outstanding the entire year. Okay. Okay, good. Let's take a look at this one. So we had some practice with the numerator. Now they're going to give us some practice with the denominator of the primary earnings per share. Okay, good. Looks like most of us have had a chance to try this one, and it looks like just about everyone got it right. So let's go ahead and take a look. This is kind of unusual for a CPA exam question to have that many choices that tightly grouped together, just a few cents off. But the correct answer here is B. And so let's just go ahead and take a look at this. And we know right out of the gate, because there was no situation where they had any additional shares being issued or stock splits or stock dividends or treasury stock involved, we know that what 200,000 is our denominator. Okay, so we get that. Okay, now what happens? They tell us that they have this $10 par value, 4% cumulative shares, and they tell us that that's 250,000. Now, if it's cumulative, that means what? That means that when I would calculate my income available to the common shareholders, I would do what? In year one, whatever the net income was, right? They don't tell me, but it doesn't matter for this question. I would have to do what? I would have to go ahead and say, well, 250,000 times what? Times the 0.04, because it's 4% cumulative, right? And the outstanding capital balance is 250,000. So I would take 10,000 for year one, wouldn't I, off of the net income to get the income available to my common shareholders. That's kind of hard to read, but that's saying income available to common shareholders. And whatever that number would be, that's what I would use for year one, right? And then year two, I would go ahead and I would do what? For year two, I would also have to take, and now they did give me the income number, which is what? 500,000, and I subtract what? I subtract the 10,000 because it's cumulative. I don't care if it's declared. I don't care if it's paid. All of that paid information they're giving you down there is a distractor, isn't it? It doesn't matter. It does not matter whether it's declared, whether it's paid. If it's cumulative, you take it off. Okay. And so what happens now, we come over and we have the 500,000 minus the 10,000. That gives me 490,000, which I guess I can bring down here now. It's already set up my 200,000 down there for the number of shares. 200,000 divided into the 490 is how we got the 245. Okay, so that one was a little tricky, right? A little bit tricky because they started giving you the distractors of the amounts that were paid. Okay, now that is a basic earnings per share, sometimes called primary earnings per share. Sometimes it's called a simple capital structure, and you think to yourself, that was simple. I had to do all that calculation of the weighted average, income available to common shareholders. Yeah, that was simple. Okay. Now what happens is we can have a complex capital structure. Okay. And an entity has a complex capital structure when we start to have dilutive shares. Okay. In other words, we have what? The potential that additional shares could be issued, and it's considered dilutive if it causes an earnings per share number that is less than the basic earnings per share. And when we look at this, we only report a diluted earnings per share. If after looking at what would happen if some of these shares were issued, it creates a number that's higher than the basic, we don't report that. Further, we consider each potential dilution separately, and we only consider what? Those that are actually diluted. You don't net a dilutive versus an anti-dilutive, an amount that increases the earnings per share. You're giving what? The worst case scenario, how low could it go, right? That's what you're looking at, okay? Now, when we look at these potentially dilutive securities, it could be convertible securities, stock that's the preferred stock that could be converted into common. We could have convertible bonds. We didn't talk really about that in the bond chapter too much, but sometimes an entity will issue bonds and they tell the bondholders they can convert those into stock. We've already talked about options, contracts that may be settled in cash or stock, and then potentially this idea of contingent shares, okay? Now, the sort of generic dilutive earnings per share formula, and it's the income available to common shareholders plus interest on dilutive securities. For example, if we had what? If we had preferred dividends, we would have to do what? We would have to consider those preferred dividends wouldn't exist anymore if those preferred shares were what? Converted into common stock, right? So now, instead of subtracting the preferred dividends, we would just take what? Net income and leave it alone, wouldn't we? Okay, and we wouldn't have to make that subtract. If it was convertible bonds, the interest that we have to pay on the bonds wouldn't exist anymore if the bonds got converted to stock. So we have to add that back to net income, but we also add it back what? Net of any tax impact. Okay, and we're going to look at these on a sort of one by one basis here, but this is the basic, the generic discussion. And then what is the weighted number of common shares, assuming all dilutive shares were actually converted into common stock? And again, we deal with each one of these separately, and we only consider the impact of what? Of the dilutive elements, not anti-dilutive, not things that cause the earnings per share to go up, and you don't net them. Okay, so you sort of take a look at this next item here, and we talk about dilution from options, warrants, and their equivalent. Okay, and we say that the dilutive effect of options, warrants, and their equivalents apply using the treasury stock method. The treasury stock method assumes that proceeds from the exercise of the stock options, warrants, and their equivalents will be used by the company to repurchase treasury shares at the prevailing market price. So think about that for a second. Remember when the options were exercised, more cash came in? Well, they assume that they take that more cash that came in, say if those options are exercised, and they go out immediately in the market and they do what? They buy back treasury shares. So even though it may be what? Even though it may be, an extra 10,000 shares that would be issued if the options were exercised, if they went out and they did what? They bought back 7,500 shares, then what? Then the dilutive impact is only going to be, now I got myself stuck on the map, the 2,500 additional shares that would have been issued after they've gone ahead and increased and repurchased those, I should say. So that incremental increase in shares outstanding, not the full amount of shares, is what you would use in the denominator. Again, we only consider dilutive, okay? Options is,
I have a question. This
Yeah.
section isn't in my book. It goes straight to dilution from convertible securities. I've got the 4.2.
okay. What I do, open up the wrong chapter here?
It's not in my 4.1 either.
Okay,
Yeah.
okay, good. Okay. What I'm saying is correct, and we'll talk about this maybe in a different section. Maybe what I did, guys. Yeah, I opened the wrong one. Okay, thank you. We will get to this. I think all they did was flip the order around. So cut. Okay, and we're gonna go ahead. We're gonna go back and open the correct book. Sorry about that.
No worries. Thank you.
Yeah, everything I said is correct. It's just they kind of pushed it back to somewhere else, but we'll get to that when we get to it. So yeah, let's go ahead and let's close this.
Yeah, I was trying to find where they were talking about what you were highlighting, and I couldn't find it. I'm sure it's
Yeah.
somewhere.
It's located elsewhere, but it's not articulated quite like that either, which maybe I did that what do they call it, Freudian, because I like the example better, the discussion better there than it is in the new book, but that's okay. We'll see where it is in the new book when we get to that. So 4.2. Everything else was the same, right? There was no differences.
Yeah, like all the questions and all that's the same.
Right. Okay, good. Let me go to full screen. Okay, and someone tell me, Michael, what page are we on?
33.
33. Okay, thank you. Okay. All right, so we should be right here, right? Dilution from convertible securities, right?
Yeah,
So everything else was the same up until there, although I think it was probably located a little differently on the page.
yeah, it was like,
Yeah,
it was like shifted a little bit, but
right,
yeah, it's the
right.
same.
Okay, good. So let's go ahead and let's take a look at dilution from convertible shares. Okay, and the if converted method assumed that securities were converted to common stock at the beginning of the period or at the time of issue if later. In other words, if the convertible security got issued in the middle of the year, then you assume that as soon as they were issued, they were converted, or they had been issued at a previous period, you assume that they were converted at the beginning of the period. Now, when we look at the question of convertible bonds, we use the following steps, and I think it is worthwhile to flashcard the steps. Okay, and what's interesting or fun about this, I guess, if I should classify any of this as fun, is you get to pretend. Finally, in accounting, you get to use your imagination, right? Okay, so let's just take a look, and we say add to the numerator income available to common shareholders the interest expense net of tax due to the assumed conversion, add to the denominator the weighted average number of shares outstanding, the number of common shares outstanding associated with the assumed conversion. If the convertible bonds were issued during the period, assume that the stock was issued at that date for the weighted average calculation. Again, if it had been issued in a previous period or was already outstanding at the beginning of the year, then just pretend like it happened at the beginning of the year. Okay, so you take a look, and in this example, we have our income is 100,000. Okay, and then they're saying that the bond interest was 20. Well, that means that what? That there was 80 before taxes. After taxes, income available to the common shareholders was 48. But what happens if there was no interest? Then the income still would have been 100, but we would have had to pay tax on 100 if our tax rate was 40%. So now the income available is 60. And then in the denominator, you would use whatever the number of shares were that were assumed to be converted. Okay. Okay, good. Now you'd have to be careful because there's a potential that you could see that this could cause the earnings per share to go up, couldn't it? Depending on how many shares got converted. You only report it if it caused the earnings per share to what? To go down, right? Okay. Okay, good. So that's again what they're saying to us here. Use the results of each assumed conversion only if result is dilutive, reduces earnings per share. Do not include the results of assumed conversion if anti-dilutive. In other words, it increases earnings per share. In determining whether potential common shares are dilutive or anti-dilutive, each issue will be considered separately in sequence from the most to the least dilutive, with options and warrants generally included first. Options and similar instruments are only diluted when the average market price of the underlying common stock exceeds the exercise price of the options or warrants. Okay, and we're going to look at options and warrants in a minute here, and you'll kind of see a little bit better what that's meaning. But why don't you go ahead and flashcard all of that so that you remember, do not include anti-dilutive. Okay, so let's just go ahead and let's just take a look at a better example now, a more comprehensive example, I guess, with the bonds in that little box we had there a minute ago. And so we have what? We have convertible bonds here. And we have company has outstanding 100,000 shares of common stock and $500,000 in 6% bonds convertible to 10 shares for each $1,000 bond. Net income for the year is 100,000. So we know we got to start with that. Then what? Now, the 500 bonds, you probably can see this, but if it's 500,000 and each bond is what? Is worth $1,000 per bond, that's where they're saying, well, look, you would have given up, the bondholders would have given up 500 bonds and they get 10 shares for each one of those bonds, right? Okay, so that's where that 500 came from. That means that we would have the common shares outstanding of 105,000. Now, the net income was 100,000, but now we get to pretend and add back what? Add back the interest savings. So if it was a 6% bond face 500,000 times what? 1 minus the tax rate, right? Means that they would have to pay some tax on that additional income. So net of tax, they're only saving what? 19,800, not the full, whatever that would come to, 30,000, I guess. It's only 19,800 that they're saving. Okay, and so we add that back to the 100,000. That gives me net income of 119,800 available to common shareholders. Divided by the 105 shares gives me what? Gives me $1.14 earnings per share. But I have to compare that to what? The basic without the conversion, and my basic without conversion is only what? Is only $1. So I would not report that $1.14 because it's anti-dilutive. It's kind of like, really, I had to go through all that. Just, it's kind of like, you know, it's kind of like you own a restaurant and you have to order garnishments on the plate so people can throw them away. It's one of them kind of things. You get all that just to throw it away. Great, thank you. Okay, now you come over and we look at, well, what happens if it's convertible preferred stock? Okay, and now we adjust the numerator, okay, so that it's not the subtraction of the preferred dividends. So it's a little tricky because your instinct is going to be to add back the preferred dividend and net income. No, you just leave net income alone, right? You don't have to add back the preferred dividend. You simply leave the net income alone. And then you have to add the number of shares to the denominator associated with the conversion. Okay, and again, the anti-dilution rules apply here. Okay, so you come over and you take a look. We have common stock is 100,000, convertible securities. There were, okay, but they don't mean dollars here. That's a typo. That's not dollars, that's shares. Okay, so strike out that. They shouldn't have put a dollar sign there. Okay, so that's the 100,000 shares. And then what? They say that the 10,000 shares of convertible preferred stock are convertible into 5 shares of common stock. So 10,000 times 5 gives me 50,000. So I'd have potentially 150,000. Now notice here, guys, they do what? Dividends declared during the year were 20 and 30 on the preferred stock, and they give us the common stock amount, which is irrelevant. But don't get into the business here of adding back that 20,000. No, you simply what? You simply leave the net income alone. You don't subtract the 20,000. You don't add it back. You just leave net income alone, right? So that's 100,000 divided by the 150 shares gives me 0.67. Now I would need to look to see if that's diluted. So for the basic earnings per share, yeah, I would subtract the 20,000 because now I'm getting the basic, and for the basic, you do subtract the preferred dividends, right? Okay, and so that would have an $80. So yes, I would report, and you would see this if you pick up the, income statement of any corporation, say Apple, you see both a what? A primary or basic earnings per share and what? And a dilutive, assuming they have dilutive items. What would you report in this example if you had both of these? Let's say you had the convertible bonds and the same entity had the convertible stock. Now what would you report? So you have one anti-dilutive, you have one dilutive. What would you report?
The diluted,
Huh?
the diluted,
Yeah, I'd only report good. I'd only, I'd still report, you always report the basic. You got to report that. But then you also have to report what the potentially dilutive items, but the point behind my question is you wouldn't net these two out. You wouldn't say, well, okay, I've got one that's bringing it up and one that's bringing it down. So let me subtract the one that's bringing it down from the one that, you don't do that, right? You consider each one separately. So in this example, we would have to report the 80. You always report that, and you would report the 67, and there'd be no consideration of that anti-dilutive one. That would be thrown away. Okay. Okay, good. Now, options and warrants. Okay. And this is what I was reading to you prematurely before, but let's look at it again. Okay, options and warrants give the holder the right to purchase stock of a company at a specific price over a specific period of time. Upon exercising the option or warrant, the holder will own the shares of stock. The holder will only exercise the right if the strike price or exercise price is below the market price, as doing so would allow the holder to purchase the stock for less than what it would cost in the market. So if the market price is 25 and the option price is 30, party over. Nobody's going to do that. Game over. Who's going to do that? Why should I buy a share for $30 when I can buy it in the open market for 25? Okay. So use the following steps to apply the if converted method for options and warrants, and let's flashcard that. You'd go ahead and you compare the strike, the exercise price, to the average market price. If the strike price is above or equal to the average market price, no adjustment is necessary because nobody is going to pay $30 for something they can get for 25. And then if the strike price is below the average, the impact is diluted and the number of new shares resulting from the assumed exercise will be added to the denominator. Now, when they show you this example, I kind of feel like they left out a little bit of an opportunity to give you some numbers here. So they give you numbers, but then they don't really do much with them. So 1,000 options to purchase 1,000 common shares. We have $15 exercise price per share, $20 average market price. Is this dilutive? Yeah, because we're going to assume that people will knock each other over to buy stock at a price of $15 per share when the average market price is what? 20, right? The end of period market price is a distractor. Okay, you should not worry about that. Okay, now let me just show you, and I'm not sure why, their solution was, okay, it's going to be dilutive because the exercise price is below the average market price. But let's just take a look at this. Let's say it's 1,000 shares. It is 1,000 shares. And the exercise price is what? $15 per share. So that means what? 1,000 times 15, how much more money is going to come in? Somebody help me out. I didn't write the number down. 1,000 times 15 is
15,000.
okay, thank you. $15,000 more is going to come in, right? And they can take that 15,000 and they can buy more shares, can't they? Okay, so what they can do is they can take that 15,000, divide it by what? Divide it by the average market price. 15,000 divided by 20 means that they could buy what? An additional 200, they could go back out and buy 250 shares. If I'm doing my math right. You
I got 750.
Oh, I'm sorry, 750. They could go back and buy 750 shares, can't they? Okay, so when the options get exercised, yeah, they have to what? They have to issue an additional 1,000 shares, but what? But they could buy back these 750, couldn't they, with the additional money that comes in? They could buy treasury stock. And so net, what? The resulting difference is only 250. So you would only add 250 shares to the denominator, not the full 1,000. Okay. I'm not sure why the example just kind of chopped it off there, sort of in the middle. It's sort of like watching a movie and they get to the point where they could show you what's actually going to happen and they just kind of stop and said, therefore, nothing bad happened. Well, okay, show me how nothing bad happened. That's, well, what bad, if you want to call it bad. 250 additional shares couldn't be repurchased, and that is dilutive. That is absolutely dilutive because we've increased the denominator and nothing's happened to the numerator here, right? Okay. Okay, good. Dilution from contracts that may be settled in cash or stock. Okay. And if that's the case, if you have a situation like that, it is presumed, okay, where is it? It is presumed that the contract will be settled in common stock and the resulting shares included in diluted earnings per share if the effect is more diluted. Okay, so you just assume that you had to settle the contract in stock, and that would cause, if it is more dilutive, then you would have to report diluted earnings per share. Okay, dilution from contingent shares. Okay, let's take a look at that. And contingent shares that are dilutive are also included in the calculation of basic earnings per share if all conditions for issuance are met. For example, let's say they tell us that the shares will only be issued if net income is of a certain level, and we have met that condition, then we assume that the conversion happened even if it doesn't actually happen. Okay. So you can go ahead and flashcard that. Come over and let's just look some more at that. I think that gives a little more information here. Issue shares contingent on the attainment of a certain level of earnings are treated as follows. If dilutive, flashcard. If necessary conditions have been satisfied at the end of the period, those shares are included in the basic earnings per share at the beginning of the period in which the conditions are satisfied. If the necessary conditions have not been satisfied by the end of the period, the number of contingently issued shares included in the diluted per share is based on the number of shares that would be issuable, if at the end of the reporting period were the end of the contingency period. So you can consider both of those factors and flashcard that. Okay, good. Disclosures, and what's interesting about this disclosure discussion is they tell us cash flow per share should not be reported. So this is interesting. They're telling you what not to disclose. There is no cash flow per share that should be reported. In addition to reporting basic and diluted earnings per share for both income from continuing operations and net income, the effects of discontinued operations, the following disclosure requirements must also be met. And guys, I'm not going to read through those for the sake of time here, but I do want you to flashcard what those additional disclosures need to be for the earnings per share. Okay, all right, with all that, let's take a look at a couple more questions. Okay, good. Looks like everyone's had a chance to look at that one. And yeah, only consider what? Only consider the dilutive one, right? So everybody got that right. Only consider the dilutive one, not the anti-dilutive. So we just picked up that 1425. Okay. Okay, good. I'm not going to get into detail on that for the sake of time. I think that one's pretty easy. Everyone got that right. So let's just go ahead and let's take a look at the next one. Okay, I'm coming up on 3 minutes because I'm seeing that, okay, getting, most folks now have gone ahead and participated. So looks like most of us got this right. A couple of us didn't do it, but okay, good. Everyone got this right. And what's interesting about this one, the answer here is D. And, it's kind of like they give you all this information down here about the stock options, but the exercise price is 30 when the year-end market price is what? 25. Nobody's going to exercise that, right? They should have maybe given us the average market price, but if they give us a year-end price, no one's going to exercise that, right? Okay, so we go ahead, that's all they gave us. So we go ahead and we know that we're going to have the 125,000 in the numerator, and then the denominator is simply now going back to what? The time weighting that we saw earlier, in which we had what, 15,000 shares that was outstanding from January, February, March. So that's 3/12. From what, the 12,005 was from what, April to May. That's 2/12, all of April, all of May. And then we have what, the remaining 17,000, and that was outstanding the remainder of the year. So that was outstanding for the what, 7/12, right? Okay. And when you do the math on those, you get 3,750, you get 2,083, you get 9,917. You add all that up, that's 15,750. You take that and you divide it into the 125,000. That's how you got the correct answer. Okay. Okay, good. So, we're back in one of those things where I want to go through the statement of cash flows, but I'm worried that I'm going to be speeding through it. I think we can do it. Okay, what do you guys, you want to do it now or you want to do it next time?
Now,
Now?
Now,
Okay. All right, good. Let's do it now. I may have to push it a little bit, guys, to get it through, but let's go ahead. I think we can do it. We'll be close. Okay. Okay. Now, statement of cash flows, guys, is one of the basic financial statements. And what's interesting about statement of cash flows is you first prepare your income statement, then your statement of returns, then your balance sheet, and then you analyze the balance sheet and the income statement to generate a statement of cash flows, right? Now, as you go through, as you know, there are 3 sections: operating, investing, and financing. Okay. Now, when we report the change in cash for the period, it's cash and cash equivalents. So we remember from F3 that cash is amounts that are what, on deposit in banks, that sort of thing. Cash equivalents, we said, remember back in chapter 3, are those that what, are so near to the original date of maturity for the purchaser that they are 3 months, 90 days from maturity. So just remember that those are treated as what? As cash. Okay, we talked about that in F3. Okay, you can flashcard that as a reminder if you don't remember when we talked about that before. Now you come over and you take a look, and we talk about the couple of different methods, okay, for presenting the statement of cash flow. And we have the direct method and the indirect method. So the direct method versus the indirect method only has impact on that operating section. The investing section, the financing section will be the same regardless of whether we're using direct or the indirect method. Now, most companies use the indirect method, even though FASB prefers what? Prefers the direct method. Okay, so let's just go ahead and take a look and see what they tell us about the direct method first. And in the operating activities section of the statement of cash flows, we'll have major classes of operating cash receipts and disbursements. Okay, and we will still, however, have to provide a reconciliation of net cash flows from operating activities to net income in a separate net income to cash provided by operations in a separate section. In other words, we will still have to do what we do in the indirect method. In the indirect method, you do what? You start with net income, and then you adjust for these different things to end up with cash provided by operations. So the difference is in the operating section. The direct method, we have major classes of cash receipts and cash disbursements in the operating section. Indirect method, you start with net income and then reconcile the cash flow from operations, cash provided or used by operations. But even under the direct method, they still then make you reconcile the net income to the cash flow from operations. So most companies use the indirect method because you can simply analyze the income statement and the balance sheet to come up with that. And secondly, you're going to have to provide the reconciliation anyway. So most companies just say, hey, just use the indirect method. And thirdly, why companies like to use the indirect method is because the types of things that get reported under the direct method are sometimes things you don't necessarily want your competitors to know, like how much cash did I pay to my suppliers? How much cash did I receive from my customers? Those sorts of things. Okay, so you come over and you can see that we have an example here of a balance sheet. And we have an example of an income statement. And we're going to show you how you would prepare a statement of cash flows from that information. I'm not going to walk through that with you guys. I do want you to do that on your own, but I'm going to do what are some of the major takeaways here as to how we would deal with our various sections here, starting with operating activities. And let's just take a look at how we would calculate cash flow from operating activities using the direct method. And when you look, there are different things that get reported. You see these 6 things that get reported. So what I want you to do is flashcard these 6 things that get reported in the cash flow from operating activities under the direct method. So you have to report cash received from customers. You have to report interest received, which of course would be an increase in cash. Dividends received is an increase in cash. Other operating cash receipts. Okay, and that other category, put on the flashcard, but it's we're going to give you examples of others here in a couple seconds. Cash received from the sale of securities classified as trading securities. Cash paid to suppliers. Okay, coming over to the bottom here, interest paid is of course decreased, income taxes paid is a decrease, and cash paid to acquire trading securities, of course, would be a decrease in cash. Now, flashcard, you have to have these things being reported if they exist, of course. You don't have to put 0 if they didn't happen, but if they happen, you have to report those in the operating section. But what I want to do is come back now and let's just take a look at how they tell us to calculate some of these cash received from customers. Now, when they talk about increase minus increase plus decrease, I don't like that. Just take a look at the change in accounts receivable, right? I mean, it either increased or decreased, didn't it? It'll either increase or decrease. What is the change in accounts receivable? And then I want you to put here, do the opposite. is put there, do the opposite. Do the opposite. What does that mean? So if the accounts receivable did what? If it increased, subtract it. If it decreased, what? Add it. Okay, which is what I guess, maybe that's what they're trying to show you there. But the way they say minus increase plus decrease, I get it. Just what's the change? Do the opposite. I still like the way I'm saying it. Okay. If it's what? If it's the unearned revenue that we're talking about, okay, the change in unearned revenue, because it either increases or decreases, change in unearned revenue. Do the same. In other words, if the unearned revenue increased, add it. If it decreased, subtract it. Okay, so put that on a flashcard. I like doing it that way than saying plus minus. Just what is the change? Do the opposite if it's receivable. Do the same if it's unearned revenue. And of course, we're adjusting what? We're adjusting the revenue number, the sales number there, to come up with the cash received from customers. Okay. Okay, good. Now, when we look at the cash paid to suppliers, okay, include a flashcard, okay, that says, well, what is the change? I'm going to use this delta for change. What is the change in my inventory? And the answer is what? Do the opposite. And then I will look at my what? Change in AP is the change in accounts payable. And I'm going to what? I'm going to do the same.
Isn't it do the same for inventory and do the opposite for AP?
Cost of goods sold, I'm trying to turn it into cash paid by suppliers. So if my accounts payable did what? If my accounts payable went up, that means I haven't used cash to pay for that inventory, doesn't it? If my accounts payable went up, right, that means I haven't paid cash for that inventory.
Okay, yeah, so
So,
cash hasn't gone up. Okay,
so I would have debited cost of goods sold, right? For say $100, and I would have
Yeah.
credited accounts payable for 100. Say I didn't have any accounts payable previously. So accounts payable went up, but I didn't use any cash, right? So since it went up, I should subtract it, right?
okay, yeah, that makes sense.
I mean, since it went up, I should add it back.
Yeah,
So my
if it
cash
wasn't
paid to
used.
suppliers would have been 0 in that case, right?
Yeah, okay.
That's
thank
why I'm
you.
having you flashcard these, because, you know, and then you're gonna flashcard them and you're going to then memorize the cards and then apply them to the problems, and you do that enough times that this starts to become pretty straightforward for you. But having said that, and looking at the time, I don't want to go any further. We're not gonna be able to finish it. It's not gonna work. We're gonna be here too long. Okay, so here's what we're gonna do. This is a good start, but we're gonna start this over again. We're gonna start all over again on Tuesday, and we're gonna do this, and then we're gonna get into governmental, okay? Because I can't do it. I thought I could, but I can't, and it's, trust me, guys, I've got enough experience with this kind of stuff that we're gonna start to have meltdown. So I think we've done some good work here today. We'll do statement of cash flows next time, and then I'm going to jump us straight into governmental next time. So this will take us about a half hour to do, and I'll start it all over again. I'm not gonna expect you to pick this up again. Okay. Okay, good, guys. So you've got the work to finish chapter 6 now, chapter 7. Oh, go ahead and look at the stockholders' equity section on your own, including the treasury stock, because I don't think we're gonna have time for that either. So what I want to do is I want to do statement of cash flows next time, and then I'm going to jump us into module 8, and I'm going to jump us straight to the part of module 8 that deals with governmental. Okay, we'll do that next time. Okay, guys. Sorry, I thought we might be able to finish it, but it's not going to happen.
Good
Thank
night.
you.
Thank
Have a
you.
good evening.
Thank you.
Have a good
Have a good
night.
night.
All right, bye-bye.